Hey, do you want to find out what Kiplinger recommends you need to invest in? And you know what's the best part? I'm going to break it down. I'm going to pick out their stocks they say you need to invest for passive income for the next decade. Not for the next year, but for the next decade. So pay attention, listen in, and you might find something you want to invest in pretty soon. Welcome back once again. Passive Income Tom bringing another show this Friday. If you're a new subscriber, welcome. Please subscribe, click the bell for notification. I bring a passive income video every Friday. You know, I've been doing investing for over 20 years. I think I know what I'm doing, all right? If you're coming back, returning subscriber, welcome back once again. As I mentioned, I'm going to talk about what Kiplinger recommends the best investment you need to look at for the next decade, not for the next year. You know, we're coming up in 2020. You know, we're going to finish off all these teens, the 2011, 12, 13, 14, 15, 16, 17, 18, 19. And in a few days, we're going to be into 2020, another decade. Right now, if you haven't seen, the markets are overheated. Stocks are really at their high. You know, a lot of them are really overvalued, in my opinion. None of this is financial advice, but it's just my opinion. But I'm going to give you what Kiplinger recommends you need to find out what you need to do. I know a lot of you busy, don't have time to read, so I'm going to do all the research for you, and I'm going to lay it down for you and give you pick out the stocks they recommend. They came out with 10 stocks for the next decade, but not all of these are passive income stocks. So I'm going to break it down for you and give you really quickly what you need to find out. And I'm going to highlight it quickly, and I'll show you the quick snapshot on these stocks that you need to check out for the next decade. Something else you might want to add to your portfolio. Okay. The first one I recommend is Bear AG. Bear AG has a yield of 8.8%. Currently, as of this article, it's trading at $19. Quick little overview on what Bear AG is. You may have heard of it, not really familiar with it too much, but Bear AG, a pharmaceutical and agricultural technology firm, Bayer acquired fellow agricultural giant Monsanto in 2018, and in doing so, opened itself to legal risks related to weed killer Roundup. You may have seen these stories about Roundup, people getting cancer and stuff like that. As plaintiffs allege health side effects to users, investors dumped Bear AG, which is now dirt cheap. The shares, which trade in the U.S. as American Depository Receipts, traded only 10 times estimated earnings for the year ahead, a significant discount for the 5-year earning price ratio of 23. The firm is likely to settle lawsuits for less than investors first anticipated, says Oakmark International Fund Manager David Harrow. In the meantime, investors have a bargain price entry point into the business with best-in-class agricultural technology, producing seeds, pesticides, and digital monitoring systems that enable farmers to yield more than crops using fewer resources. The growing population is going to continue arable land, which will continue to shrink, and technology is needed to feed a hungry world. The firm's healthcare, 48% of sales, should continue to grow as well, he says, with a strong pipeline of meds to back current blockbusters such as blood thinner Azerto and macular degeneration treatment Azalea. All right. The next stock is Boeing. If you haven't heard, Boeing's had some airplane crashing, so the stock has dropped considerably because of that. The stock has a yield of 2.49%. And as of this article, it's trading for $340. It's no secret why Boeing stock is trading 24% below its 52-week high. The firm's 737 MAX aircraft, which suffered 2 fatal crashes over the course of 5 months, is still grounded. The snafu is taking a bite out of Boeing's 2019 earnings. But a fix is in the works. It's only a matter of time before the aircraft receives approval to begin flying again, says Montero Fund co-manager Bob Bacalera. In the meantime, Boeing's a backlog with more than 5,500 commercial aircraft orders, contracts worth $500 billion. $500 billion. That Morningstar analyst, Joseph Aguilar, expects will boost sales and expand margins to the next decade. The firm's aerospace division will also benefit from continued increase in U.S. military spending, Aguilar says. Plus, Boeing expanding its services business, which provides support, spare parts, and modification, and data analytics, among other things, for existing aircraft. Boeing expects that segment to generate $50 billion per year in sales up to 2027, up from $17 billion in 2018. So it goes from $17 billion now in sales to $50 billion pretty much in the next eight years or so. The next one is Fox A with a yield of 1.25%. This isn't the big old Fox. Disney bought in 74% of the firm in 2019, including the film studio, the FX channel, and Fox's stake in streaming service Hulu, What remains is News Fox. Fox News, Fox Sports, Fox Business, affiliate news standings, a share in the streaming platform Roku and the Fox Studio lot, currently leased to Disney. Like most TV and cable companies, Fox makes money from advertising, distributing, and licensing fees for its programs. Fox is better at its news and sports program, which viewers tend to watch live, will be less affected by the trend of viewers cutting the cord and streaming content digitally. The streamed down Fox boasts all-star executive, says Yachman Fund co-manager Jason Sabot. The firm is financially healthy and small enough with a $20 billion market cap for smart investments to impact returns. Fox recently invested $236 million in partnership with the Stars Group, a Canadian gambling firm, to launch Fox Bet, an online sports betting service that will operate in 13 states where sports gambling is legal. Should sports gambling become legal nationwide, the business could take off. Wall Street expects a dip in earnings this fiscal year, which ends in June 2020, followed by a 23% boost next year. 3 more stocks to go. Huntsman, which is a yield of stocks to go. The next one has a yield of 2.63%. Huntsman, ticker symbol HUN, trading at $22 a share. Chemical producer Huntsman is in the midst of transformation. The company is ditching bulk sales of commodity chemicals, widely available compounds, a business prone to boom and bust cycles, and favors more predictable, higher profit specialty chemical operation. The company recently inked a deal to offload 2 commodity chemicals units for $2 billion in cash, a major influx for a company with $5 million in market value. Company execs have shed unprofitable businesses and paid down debt to improve the firm's balance sheet. This year, credit ratings agencies upgraded Huntsman to an investment-grade BBB rating after years in junk territory, citing the firm's commitment to debt level management, among other reasons. With sales trading at 13 times estimated year-ahead earnings, investors have yet to appreciate changes at the firm, says Roy Specialty Equity Fund co-manager Charlie Dreyfus. Following an expected dip in earnings growth in 2019, analysts and investment bank UBS expects the firm to boost earnings at an annualized 24% clip through 2023. The share yields 2.9%, as I mentioned earlier. All right, do you like chicken? Maybe we'll invest in this stock coming up here. This stock gives a dividend of 1.89%. The stock is Tyson Foods. Ticker symbol TSN. Currently has a ticker, trades at $83 a share. Tyson, one of the world's largest supplier of beef, pork, and chicken, stands to benefit from misfortune on the other side of the globe. African swine fever has killed more than 20% of China's pork herd and may force an even greater call. In an unfortunate development, but CFRA analysts say it could kick off a multi-year boost in Tyson's pork sales starting in 2020. So other than this chicken, they also invest in pork as well. The company's meat business already stands to gain over the next decade from the growing global middle class, which will drive exponential sales and protein demand, says T. Rowe Price Value Fund Manager Mark Finn. Meanwhile, Tyson is also expanding its prepared food business, currently 21% of sales, which comes with higher profit margins and less susceptible than the meat business, so swings in commodity prices. The shares trades at 13 times year-ahead earnings, below the market multiple of 17 for the food and meat product sector. So this might be a good one to put your money into. I know we all like to eat a lot, so it's a great way to invest back into something that you may eat. Okay, now we're down to the last stock. The last stock has a yield of 1.92%. Systemax, currently trading as $22 a share when this article is printed. Systemax is a direct marketer of industrial and business equipment and supplies, selling everything from personal computers to pallet jacks, using warehouses to lift and move wooden pallets. In recent years, the company sold off its struggling overseas business in order to focus on its core of U.S. distribution, unearthing a gem of business, says Grandeur Peak Contrarian Fund co-manager Kiefer Babbitt. He says Systematic's well-trained sales staff, easy-to-use website, and efficient warehouses allow the firm to offer superior service to small and mid-sized businesses. And CEO Barry Letwit, who took over in January 2019, has energized the firm with new initiatives, among them efforts to streamline the firm's distribution network. Systemax carries $96 million in cash on a debt-free balance sheet, money that Babbitt says the firm could use to make an acquisition or invest in growth products. So this one pays a dividend, and also has the potential for growth. He expects Systemax to boost sales at an annualized rate in the double-digit percentage over the next 5 years. I mean, so what did you think about these stocks I just talked off? A lot of these pay dividends. I mean, all 5 that I mentioned pay off dividends, and some you should really consider over the next decade, because really, if you're looking for passive income, you're investing for the long term. You're not looking for that quick fix. You're not looking for that stock to take off just like that. You want something to pay a steady income consistently over time. Of course, there is the chance that any of these stocks could stop paying dividends in the near future, but you don't know when that's going to happen because you don't know the further details, what's going on in that company. But they have been paying dividends. You know, I've mentioned they've all been doing well and they've been highlighted as potential growth stocks over the next decade. And there aren't that many challengers that are going to compete in these sectors. So if you like any of these stocks, let me know. Drop me a comment below. Let me tell you, or maybe you may invest in some of these now. Let me know if you're investing in one of these stocks. And, you know, I'd love to hear what your thoughts is. Other of my fans on my page like to hear that as well. All right. If you don't have any questions, you may comment below. Like and subscribe to this video. And check out these other videos I'm going to highlight here. You may want to check them out as well. The next video you need to check out. But overall, have a great day. If I don't see you before Christmas, have a Merry Christmas as well. Happy holidays. Take care.